Hey guys, welcome to your quick market update. Today is Friday, April 3rd, and we had a solid week of gains, largely because the market appears to have taken a rate hike off the table last week. That was still a concern due to rising inflation tied to those higher oil prices. Have you been to the pump lately? Ugh. Anyways, but sentiment shifted after the University of Michigan Consumer Sentiment Index dropped sharply, driven mainly by fears around unemployment. In fact, 61% of consumers now expect unemployment to rise over the next 12 months, while only 13% expect it to fall. And this, guys, is a gap you typically only see during recessionary periods. That shift was reinforced by comments from Fed Chair Jerome Powell, who indicated the Fed can look past oil-related price shocks, and as a result, the probability of a rate hike dropped dramatically from 50% down to only 2%. Thank goodness. We also had several important labor market reports this week. We got the JOLTS report showing continued softening in job openings. They fell down to 6.88 million, and hires dropped down to 4.8 million, the lowest levels we've seen since March of 2020. ADP came in stronger than expected at first glance, but nearly all of the job gains, 58,000 out of 62,000, came from the education and health services. And here's one thing you gotta keep in mind. Those sectors, education and health, tend to be less sensitive to the broader economy. So outside of that, job growth was essentially flat. That's especially concerning when you consider that 3 out of every 4 jobs created over the past 2 years have come from education and healthcare. Then on Thursday, the Challenger report showed nearly 61,000 job cuts, with 25% of those tied to AI. And then we got the Revelio report, showed just 19,400 jobs created, with nearly all of those in healthcare again. So overall, the broader labor market continues to look weak. That's what made today's BLS jobs report so surprising. Despite all the soft data leading up to it, the Bureau of Labor Statistics reported 178,000 jobs created in March, nearly 3 times the expected 60,000. As Britney Spears would sing, "Oops, I did it again." They also reported 18,000 government jobs lost, which only adds to the disconnect between this report and the rest of the labor data we saw this week. Now, it's holiday shortened weekend, and the market is down today, but not as much as I would have expected. My view is that once the market fully digests this report, probably next week, it may ultimately look past it and could rally back and bring rates back down a little bit. The main concern for markets still remains the conflict involving Iran. As long as those tensions continue, rates are likely to stay elevated. But if we get any kind of de-escalation or a peace agreement, rates could move down quickly. And based on the weakness we're already seeing in the labor market, I believe they could fall back toward the levels we saw before the conflict even began. I like to use the word plummet. For now, this is still a great opportunity to remind clients that uncertainty creates opportunity, and this may be one of the better times to buy this year. Thanks so much for watching. Have a great weekend and happy Easter.